Nicholas Darvas' journey didn't start in a plush office or with a fancy degree. It started under neon lights, in crowded nightclubs, where he commanded attention on the dance floor but had no clue about the world of stocks. Each performance gave him adrenaline, applause, and confidence, yet none of it prepared him for the harsh reality of the market. One evening, after a show, a friend mentioned a hot tip on a stock. The idea seemed simple: buy, hold, and profit. Darvas, like many amateurs, ignored the most critical elements: position sizing, stop losses, and emotional control. He plunged in with enthusiasm, treating the stock like a dance routine, assuming grace and flair would be enough. Within weeks, his capital shrank significantly, leaving him stunned. The lesson was painful but vital. In trading, mistakes hurt not just the ego, they hurt the wallet. Watching the tickers while sipping post-show coffee, he began noticing subtle movements, rhythms, and patterns. He realized that what seemed chaotic on the surface followed measurable trends underneath. Stocks moved with momentum, paused at pivotal points, and repeated in ways that could be anticipated with careful observation. The amateur mindset, driven by fear and greed, reacted impulsively, often entering too early or too late. Darvas started experimenting with waiting for the market to confirm a move before committing. That one principle, waiting for confirmation, became a shield against unnecessary losses and emotional whiplash. Slowly, he combined observation with a systematic approach, defining entry points, using stop losses, and sizing positions appropriately. His nightclub discipline, rigor in rehearsals, attention to timing, and persistence, translated surprisingly well to trading, but only once he respected the rules of the market. The transformation wasn't overnight. Every trade, whether profitable or not, taught him more about human behavior, both in the market and within himself. Patience replaced impulsivity, analysis replaced guesswork, and structure replaced chaos. By the time Darvas mastered this method, he had created a framework any amateur could follow, one that could turn small capital into significant gains. Chapter 1 sets the stage. It contrasts impulsive amateurs with disciplined professionals, introduces the foundational principle of waiting for confirmation, and teases the essential lessons on risk management and position sizing that will define Darvas' rise. It's not about talent, luck, or tips. It's about observation, patience, and systematic action. By understanding this, any trader can begin to bridge the gap between naive ambition and structured success. Nicholas Darvas quickly realized that controlling risk was not just a guideline, it was a lifeline. In the early days, he treated trades like bets at a casino, throwing large sums at a stock on impulse, convinced that intuition and luck would prevail. Each swing of the market tore through his capital, leaving him frustrated and anxious. That approach was common among amateurs: high stakes, high emotion, and high probability of ruin. Darvas' breakthrough came when he adopted a strict rule: never risk more than 5% of total capital on a single trade. Suddenly, the fear of losing everything evaporated because he had a safety net. Losses became manageable, setbacks temporary, and the ability to act tomorrow preserved. One vivid lesson reinforced this principle. A stock he had been studying dipped 12% in a single session. Months earlier, this drop would have caused panic and a hasty exit. This time, he did nothing. He simply watched, understanding that the position was small, controlled, and within his risk tolerance. By staying patient, he witnessed the market's natural rhythm, and within days, the breakout he had anticipated materialized. The calculated risk now yielded a profit that would have been impossible under reckless exposure. Position sizing was more than arithmetic, it was psychology. Knowing your exposure is limited keeps emotion in check. Amateur traders often confuse courage with recklessness, buying large positions to prove themselves, or chasing every rumor and tip. Professionals understand leverage differently. It's not about doubling your money in a single trade, it's about staying alive to double it consistently over time. Another subtle, yet critical lesson Darvas learned was that sometimes doing nothing is the most powerful move. Sitting on a position while the market fluctuates, resisting the urge to react to every tick or headline, required patience and confidence in observation. This restraint is a stark contrast to amateur impulsivity, where each movement triggers action and anxiety. The discipline of position sizing allowed Darvas to survive dips that would have ended his career early, creating the foundation for more advanced strategies. Survival, he realized, is the precondition for growth. You cannot accumulate wealth if you are wiped out by the first storm. Chapter 2 emphasizes this professional mindset: measured risk, disciplined waiting, and emotional control are the tools that separate amateurs from masters. But survival alone isn't wealth. The next step, knowing exactly when and how to pyramid positions, would transform disciplined risk into extraordinary gains. Darvas' approach to pyramiding was deceptively simple, yet profoundly effective. He never added to a losing position. That principle alone separated him from the majority of traders, who panic or chase the market blindly, often compounding losses instead of gains. Darvas waited for confirmation, proof that a stock was genuinely moving in the desired direction, before layering additional positions. He treated each new addition like a vote of confidence from the market itself, not a leap of faith fueled by hope. One memorable example involved a stock forming a textbook box pattern. Darvas entered with a modest lot, observing quietly as the price respected the boundaries of the box. When the breakout occurred, he added another layer. The movement repeated, and he added again. Each step was deliberate, incremental, and rooted in market validation. By the end, an initial $5,000 trade had grown tenfold, demonstrating the power of disciplined pyramiding. The underlying principle is critical. Amateurs seek instant gratification. They react emotionally, chasing sudden spikes or desperately averaging down on falling positions. Professionals, by contrast, wait, measure, and add only when certainty is established. Compounding through pyramiding is not an act of luck. It is a systematic protocol for scaling winning trades while maintaining control over risk exposure. Darvas' method also required patience. He resisted the urge to cash out too early, understanding that premature exits could erode potential gains. Each incremental addition amplified profits, but only because it followed a disciplined observation of price behavior. The mental game was equally important. Pyramiding exposes traders to the temptation of greed, wanting to accelerate gains faster than the market allows, and fear, the instinct to exit at the slightest retracement. Darvas managed both by strictly adhering to his rules, using position sizing to mitigate anxiety and preserve capital. He treated every layer as evidence, not speculation, anchoring decisions in observable market behavior rather than emotion. Over time, this disciplined approach transformed modest starting capital into life-changing wealth. It reinforced a critical professional mindset. Trading is not about heroics or intuition. It's about structured protocols, careful observation, and compounding certainty. Pyramiding, when executed with patience and confirmation, becomes a force multiplier for disciplined traders. Yet even with a perfect system, human emotion remains a lurking challenge. How did Darvas prevent fear, greed, or impatience from unraveling his careful pyramids? That question sets the stage for the next chapter, where the mental architecture of professional trading is revealed, showing how the mind becomes the ultimate ally in wealth creation. Darvas realized early on that the greatest battles in trading were fought within the mind. Each tick of the ticker brought a surge of emotion, fear to exit too soon, greed to chase the next spike. Amateur traders surrendered to these impulses, reacting instantly and often destructively. Darvas understood that controlling psychology was far more important than controlling capital. He treated charts like a meditation, observing patterns with focus and detachment. To reinforce discipline, he externalized rules on paper, stop-loss levels, strict position sizing, and the guideline to pyramid only after confirmation. These rules acted as a framework, a scaffold for decision-making that kept him grounded when emotions surged. One vivid example illustrates this principle. A hot tip promised overnight riches. The stock spiked dramatically, enticing amateurs to jump in with reckless abandon. Darvas examined his box pattern, looking for confirmation. Seeing none, he did nothing. The next morning, the stock collapsed. Those who had chased the spike lost heavily. Darvas lost nothing, except the pang of fear that comes from watching opportunities pass. This incident highlighted a subtle but vital truth. Waiting is not weakness. Doing nothing strategically is a demonstration of strength. Professionals build confidence not on rumors or fleeting trends, but on rules they can trust. Each rule becomes a defense against impulsive decisions, a tool for consistent action, and a buffer against emotional volatility. Over time, this disciplined mental architecture allowed Darvas to act decisively when genuine opportunities emerged. Fear no longer dictated exits. Greed no longer dictated entries. Every decision was filtered through a protocol that prioritized observation, confirmation, and calculated risk. The result was a psychological edge that amplified his trading method. He could remain calm when the market fluctuated wildly, knowing that his actions were grounded in rules, not emotion. This mastery of the internal tape was as important as understanding price movements. It was what turned a nightclub dancer with no formal training into a disciplined, methodical trader capable of consistent gains. Yet even with emotional control secured, a critical question remained. Which stocks were truly worth trading? How did Darvas select the opportunities that would become the backbone of his million-dollar success? The answer lay in a system that seemed almost mystical to outsiders, a methodical approach to stock selection that transformed disciplined rules into extraordinary wealth. Chapter 5 will reveal the signature methodology behind these choices, the blueprint that guided Darvas from cautious observation to remarkable fortune. Darvas' defining edge was his box system, a deceptively simple method that eliminated guesswork and speculation. He ignored hot tips, headlines, and market chatter, focusing solely on stocks forming tight trading ranges, boxes. Each box represented a period of consolidation, where price oscillated between a defined high and low. Darvas patiently watched, knowing that true opportunity came only when the stock broke out of its box with significant volume. One vivid example illustrates this principle. A stock traded consistently between $50 and $55 for weeks. Rather than jumping in at every uptick, Darvas waited for the breakout above $55 on heavy volume. Once confirmed, he entered with a modest position. In the following weeks, the stock surged, doubling in value. The lesson was clear. Patience, discipline, and adherence to rules were far more profitable than chasing rumors. The box system wasn't magic, it was structure. By externalizing his decision-making through defined rules, Darvas neutralized fear and greed. Each trade followed the same protocol: cut losses quickly, limit position size, wait for confirmation, add incrementally to winners, and own the process. Emotional impulses became irrelevant. Mini losses no longer threatened capital, and gains compounded through carefully pyramid positions. This disciplined approach transformed a nightclub dancer with zero trading experience into a professional capable of turning $36,000 into over $2 million. Beyond the mechanics, the system trained Darvas' mind. Observation replaced speculation, waiting replaced impatience, and rules replaced hope. Every breakout became a test of protocol, not emotion. Even when the market tempted him with sudden spikes, he remained steadfast, entering only when conditions met his predefined criteria. The box system also provided a roadmap for continuous learning. Each completed trade reinforced the importance of risk management, position sizing, and pyramiding, creating a cycle of disciplined observation and compounding success. For aspiring traders, the takeaway is actionable. Define your rules, respect them, and let structured observation guide decisions. Avoid chasing tips or acting on impulse. Use the box system as a scaffold for mental and financial discipline, knowing that patience and adherence to protocol are the real sources of wealth. As Darvas demonstrated, consistent application of these principles transforms amateurs into professionals. With this foundation, traders can move beyond survival and disciplined execution toward mastering broader market cycles. Understanding the box system sets the stage for riding trends like a pro, identifying opportunities before the crowd, and compounding gains over time. Chapter 5 closes the narrative loop on Darvas' transformation, highlighting rules over hope, patience over impulse, and discipline over emotion, while bridging to the next lesson on reading and riding market cycles with confidence.